So first things first, just want to highlight a few team members that are joining us today. We have a new face, Monica Khalid, who's going to work with us today on allowing other individuals that might join late and getting them into the meeting. But big welcome. This is her first month with Ausperity. Additionally, we have Sean Fasanella, Shane Fox on camera, along with Mike Veneria and Jeff Degener as well. Jen's currently attending a leadership meeting. And then also our main talent for today, Pat McGowan. Pat, you're good on audio? Everything good on your part? I think you're on mute.
Hey, Rory. Yeah.
Okay.
How's that?
Good.
Great.
That's great. Super.
Thanks for having me.
So we are going to be recording this, and we will be putting it on our YouTube channel. So for friends of yours, family members that haven't been able to attend this live, just so you know, we will be posting the content and diving in. So let's get started here. The topic for this month's webinar is investing in private markets. This is an asset class that our firm and our group essentially went from almost a zero allocation to about 5 or 6 years ago. It now represents 10 to 15% of our typical client portfolio allocations. We're going to dive into what are private markets and why investors should consider allocating to them. As I said before, I'm joined by Patrick McGowan. He is the head of alternative investments and manager research at Sanctuary Wealth. Pat, thank you in advance for your time today and also for any of the insights that you're going to be providing. Thanks a lot, and welcome to this month's webinar series.
Thank you for having me. And to your point, Rory, it's been great working with you as you've been building this up, and particularly in exposure to private markets. You've become a leader at our firm in it. So thank you for having me. And yeah, looking forward to the chat.
Absolutely. Great.
Yeah.
So we'll dive in here first. Let's start basic. So Pat, in your own words, what are private markets?
So private markets, and you can see on the slide here, they're not exotic. They're just private. So by grasping the concept of public equity or stocks or fixed income, you already possess an understanding of private markets and private equity. And so what that means is, on the left-hand side of this chart, that is relatively simple, but it's really not complicated, is equity is ownership in a business. So when you buy a stock, when you turn on, your trading account, or you buy a stock, or even a basket of stocks through mutual funds or ETFs, you're owning a part of a business.
Right.
And when you buy, that can be done on through an exchange, or that can be done by actually buying a private company, and hence private equity or public equities. Fixed income, if you understand fixed income, which is a loan, or you're receiving a coupon interest payment. You've made a loan to a business, or you've made a loan to a government like a muni or a government. You're receiving a coupon. It's the same thing. Is that if you've made a public loan, and a bank has created it. You've created a bond. You've created a high yield bond. You've created an investment grade bond. And we'll talk about companies, but if you've made a private loan to a private company, they call it private credit. So again, they're just private. And if you understand the concepts of the public side, you possess the understanding of it it's really not complicated on the private side too.
Mm-hmm. Yeah. And we're going to dive into a little bit more of private equity. And then we're going to finish today with private credit or private loans, which happens to be an area of particular interest for us recently, and we're continuing to add to that space. So as we kick off, I think that this visual and this chart is tremendous. So commonly, investors really associate private companies with smaller companies. And this chart highlights that that's not necessarily the case. So walk us through, Pat, what this chart's really showing us, certainly starting at the bottom with the public companies in gray.
It's exactly so to walk you through it, the gray bars on the bottom, and this source is from Bain, one of the largest private equity managers in the world, and S&P Capital IQ, but essentially The gray bars are your publicly traded, or your public companies, companies that have IPO'd. So this whole chart are all the companies in the U.S. Um, with over $100 million of revenue, because there's millions and millions and millions of businesses. Everybody has a private business, but if you just limit it to really good businesses that make $100 million of revenue a year, and you start with that benchmark,
Hmm.
those gray bars are the only ones that are actually public. So and then the red are the ones that are private. And I think going back to that initial point is, if you have a fundamental understanding of public equities, when you think about that, we're talking about those gray bars right there.
Yeah.
And when you're talking about public fixed income, again, you're talking about the gray bars right there. So what we're talking about is, if you understand public credit and public equity, private equity
Hmm.
is all the red bars. And we'll dive a little bit deeper into this, but less than 15% of companies with over $100 million in revenue are actually public.
Yeah.
So you're getting investors only have a narrow exposure to the broader economy. And so this is this has really led, and we'll talk more about this, but it's led to a really restricted level
Mm.
of market exposure for public investors who may find it difficult to invest in these private companies. And it is attributable to a bunch of factors that we'll get into, but the bottom line is that this lack of you're missing out on the potential diversification benefits that we all appreciate, that the more companies that you may have access to or buy,
Yeah.
that process alone, this would highlight that you're missing out on a large variety of companies.
Yeah, this is, I think, a massive misconception and something we speak to our clients and then prospective clients, and it's an educational process to look at that. The gray bars, which are public companies over $100 million in revenue, that's kind of the only growth investments that many investors have, because they're buying stocks on the stock exchange, they're investing in mutual funds or ETFs. What you're seeing is you're really limiting yourself. And I think you're missing a massive part of the US economy if you're not allocating, if you're not investing into some of these private businesses that are not small by just your natural thought. The reality is these are massive, very large businesses that have decided to stay private or actively private, which
Yeah,
leads us. Go ahead.
yeah, and that leads us to this. I think that's a great segue. That we wanted to. I don't want to jump in front, but I think that when I look at this chart, um, you know, mutual fund and ETF managers, or folks that like to pick companies, they are, um, a large company like on this list that's on the public side. Let's pick on JP Morgan,
Yeah.
just because they're at the top of the list. JP Morgan's probably covered by 20 analysts. Every single mutual fund manager in the world thinks that they have an advantage of when they should buy that stock or not buy that stock, or a view on all of them. There's no information, pricing, benefits. Everyone's covering it. They're
Sure.
all getting the information at the same time. And so not only are we investing in that small sliver of companies that are public, but they're also all covered by the same people. So it's really hard to really get any further tangential, like any more beneficial benefits of it via diversification. So, but this chart is interesting, Rory, if you want to talk a little bit more about this on
Yeah,
both sides.
I think when I first looked at this, what jumped out at me was the number of common and just household names, if you will, that are private companies that I think the typical individual would have thought, oh, those are public. Those are stocks that I can buy. Reality is no, right? So to point out a few, State Farm, Deloitte, Nationwide. Further down the list here, we have Publix, which is a supermarket chain, Fidelity Investments, which is the custodian that we hold all of our client assets at. And then for those in the northeast area here, everyone knows Wawa. These are privately held companies. You can't invest into these companies because there's no stock to purchase on the stock exchange. the only way to get exposure and benefit from the growth of these private companies is to be fortunate to be investing into a private fund or a private manager. And many times it's access. And that's something that thankfully we're able to provide more of as an independent firm in getting clients exposure. So hopefully with the previous slide, you saw that there's a tremendous amount of private businesses in this country. Getting the access is very difficult because individual investors cannot sign into their self-directed investment account and purchase shares of Wawa or purchase shares of Nationwide, for example. So as you just kind of look down that list, there's a lot of household names there that are still private. And, Pat, maybe talk us through why would these large billion and multi-billion dollar businesses, companies decide to stay private rather than go public, which I know will lead us to the next slide. But why do we
Yeah.
have these massive private businesses that are not going public?
Yeah, and I'll tell you, tell you why, and it's mainly because of regulation. It's private companies, um, folks that are of this size. These companies could go public. So the point of this chart is to highlight that Cargill could go public. They're as big as J.P. Morgan. They have as much revenue. So why
Yeah.
don't you do it? And it's because they would have to disclose all their financial information on a quarterly basis. So they wouldn't maintain their competitive edge necessarily.
Mm,
You see companies that were public that go private do this as well because they're like, we have to maintain this. We have to beat the analyst expectations every single quarter. We have to disclose everything we're doing. Our competitors know everything we're doing. And so if they want to do anything, everyone's going to know.
yeah.
So it makes it a challenge where they lose. A private company has the advantage where they have a confidentiality, they have less public scrutiny. A public company may not do something because it may come up in a filing, and then they may not want that to go into the press just because I don't
Sure.
know, it might be the news of the day. So
Yeah.
protection also against a hostile takeover. Some of these companies get bought by activist investors. They have no say, have to go through proxy votes and all sorts of stuff. We saw it with like Disney recently, So I think that a lot of America's largest companies prefer the status to, really, and we'll talk about skilled managers, but the company itself, in a lot of ways, can maximize profits and grow even faster, grow the business, um, the KPIs within the business, the profitability and the revenues even
Yeah.
faster or even with a longer term strategy. So,
Yeah.
that's one key thing is that I think it's, from in terms of in terms of the benefits, we talked about diversification a little bit because on one hand, if you believe in diversification, which I think most investors do, like you don't want all of your eggs in one basket,
Sure. Sure.
well, then if you own all the companies on the right hand side, if you have the ability to own a lot of the companies on the left hand side, and I'm not saying we can give you access to a lot of companies. It won't be these ones specifically necessarily, but um, you would want that. Diversification is the only free lunch, as it's sort of said. So
Yeah.
that plus the ability of these companies to potentially outperform too.
Yeah, it's been a changing environment, and one that we've been tracking, and with your guidance and help, have had in-depth discussions about the private markets and where they're headed. But the environment's changed, and what we're looking at on this slide is just showing the listed public companies on the stock exchange, the public stocks that you could purchase. When I mentioned the last 20 years, we're looking at it here. You can see 20 years ago, there were over 8,000 companies listed on the stock exchange. And as recently as a couple of years ago, only 3,600 companies. So why would that have decreased? Obviously, we have mergers and acquisitions, but coinciding with this is a trend where we're not seeing as many companies that are private go public.
Yep.
I know, Pat, you speak to the Russell 5000, only having 3,600 stocks. Maybe take us through that, but also speak to why are companies not going public. We alluded to that, but this is a
Mhm.
massive shift. And we
Yeah.
talked about diversification. I look at this and say, well, this is a lack of diversification opportunities in the public markets because you went from being able to allocate to 8,000 stocks to now you're your allocation is now restricted to 3,600 stocks. Still a tremendous amount of stocks, but vastly different than where it was 20 years ago. Is this a
Yeah.
trend that you think is going to continue?
Yeah.
How do you foresee the next
Yeah.
several years playing out?
Yeah. Well, I think this is a good chart because we're showing the original, the red chart that showed you the private companies versus the public companies shows you the slice of time where we are today. So what this chart is showing you is that
Yeah,
in the 90s, it looked very different. And so what this is showing you is that those gray bars, if it continues, which I think it will, those will get even smaller. The amount of public companies should continue to shrink.
yeah,
Um, we all know IPOs have, and since this recording happens, IPOs have certainly slowed down significantly. The banks have kind of stopped. Nobody really wants to go public right now at this moment in time, and that ebbs and flows, and I expect that to always happen in all investment cycles. But really, it's regulations. It's the Regulation Fair Disclosure Act in the year 2000. It's Sarbanes-Oxley in 2002. It's Dodd-Frank in
sure.
2010. And honestly, to address this, Congress passed the Jobs Act in 2012, which eased um, the securities regulations around private small businesses to raise capital without having to force them to go public. So if you saw, everyone's seen some of these anecdotes, but like companies like Amazon and Google and whatever went and IPO'd very very early in their
Yeah,
lives because they sort of needed to, but now because of the things like the Jobs Act and the amount um, of it combined with the regulatory burdens, they just go, let's just stay private. We don't have to go. We just don't need to go public.
yeah,
So what the other thing this highlights too, Rory, is that I highlighted before that you have analysts covering these companies on the public side,
sure.
all with the same information. They're supposed to all have the same information due to the from insider trading standpoint. But if you go into the private markets, or let's put it this way, if this trend continues, it gets even more and more competitive because more analysts are looking at even fewer companies every year, and they're fighting over all the same names, and they have to all be in the same names. That's why if you look in mutual funds and ETFs, the active ones, and let alone the passive ones, they all look the same. But the active ones, they're going to have like 99% overlap,
Hmm.
and they'll exclude a few names. But if you go into the private, let's flip it around. If you go into the private markets, there's um, limited competition in the sense that there's far more companies to invest in. So you're not all fighting over the same company in a bidding war and driving the prices up or whatever it may, or on the opposite, all trying to sell it at the same time. So it's a completely different dynamic, and we'll talk about correlations, but
Yeah.
it drives the returns of these so that there's less of the sort of like correlations of people competing or people buying and selling all at the same time.
Yeah, that's an interesting point and something I didn't put together or think of in terms of how that changes the competition. Um, so I think now it's abundantly clear that there are significantly more private companies than public, especially if we're looking at private and public companies over $100 million. So there's more of them. The question is, what's the data show us in terms of performance? Are you compensated for investing into private companies rather than being able to simply invest into the public companies? And this chart is showing that dating back to 2000, you can see that the per year return of investing into private businesses or private equity has been an over 11% per annum or per annual return. Compare that to the public stocks on the stock market. Now, I will share that this is 70% US, deemed the Russell 3000, versus 30% international market. So a diversified global stock portfolio with only a return of 5.8% per year. This is data through the end of last year, so it includes the drop that we saw and we experienced as investors into the public markets last year. But I think that that's extremely compelling. And one thing that I wanted to highlight is this gray dotted chart or just gray dotted graph here, and this trend line shows the excess return of investing in the private markets versus public. So there's more companies privately held. We know access is going to be difficult. How do you invest into these private markets? And that's where we have a huge advantage in terms of being able to allocate towards a number of different funds, a number of different private placements, et cetera. And we're able to provide that exposure to clients. But I think, unfortunately, many individual investors don't have that access. If you can access the private markets, it looks abundantly clear that you're going to be compensated for doing so with above stock market returns. So I thought that that was really interesting. One thing I'd like you to kind of speak to, or what are these bar charts, which is showing the blue and the red, where there's excess return, but it's not every single year, where
Mhm.
the returns fall between public and private. And then, as you stop, I definitely want to talk a little bit further about what happened in 2022. So walk us through some of these bar charts along these calendar years here, Pat.
Yeah, well, so the obvious sort of elephant in the room on this chart is that over a long period of time, private equity has outperformed public equity. We always say, it's called an illiquidity premium. If this is sort of the inside discussion, the illiquidity premium. So if you're going to give a manager, if you're going to invest in a private company, unlike a public company, you should receive a return for having your capital in something that you're going to have to hold for a longer, or uh, don't have the benefit of being able to sell any minute of any day. But a lot of most investors, like even myself, in the retail world and institutional world, and again, this is a state pension data source, we don't really sell all of our holdings liquidate our entire investment account every week.
Sure.
We rebalance
Right.
here and there, but for the most part, we kind of, we leave it, and we rely on guys like you to help make adjustments and tilts along the way. But over a long period of time, you don't really move it. So that illiquidity premium is generally in equities, it's about 5%, and on fixed income, it's usually somewhere between 3 to 5.
Hmm.
And what happens is this: over a long period of time, or more consistently, private equity does outperform. Particularly on the downside, it doesn't have as many um, panic selling, because you can't. I think about it like this: like if you were going to sell your house, you may know what your house is like worth today, but if you had to sell your house, turn on your trading, you go on your phone and you say, all right, I'm going to sell my house right now and put a bid ask on it.
Hmm.
You're going to have to sell it to sell it today and get a bid for it. You have to like probably drop it significantly in price. And that's the problem with the public markets is, um, at times a company may be worth X, but there are times when everybody wants to sell out of that and they are willing to get the price for it of it is what it is that second of that day. And they can all go on their phones and they can all go on their trading platforms and just sell. Conversely, they can go in and buy. And so what happens is, while the managers in private equity are really driving the the outsized return, the excess return. They're using like skill and information advantages and the fewer competition
Hmm.
and the diversification, all the stuff we talked about. They are also avoiding those swings. So they tend to have less volatility on the downside
Yeah.
over a broad scope. But there are times when it underperforms because um, everybody was piling back into stocks. And
Yeah.
so when that happens, they can underperform. But what you'll see is that it's it's when you see these massive days in the market, when the market goes up, 5% in one day or whatever it is. That doesn't happen on the private equity side. So they don't. There are times when days or certain periods of time, when you cherry pick time segments, that public equities will outperform. And
Yeah.
when public equities are down a lot, that's when I rely on folks like you, Rory, to be like, hey, these are trading at really steep discounts. We should allocate a little bit more to, you know, to our public markets. There's some good opportunities right now, but I think
Yeah.
there's a lot of times when you want to have that hold on the private side.
Exactly, and that's where we step in and we rebalance the portfolio, and we're looking for whether our asset allocation has been thrown off due to large fluctuations in the overall portfolio. Many times that's going to come with stocks, which are more volatile than the private markets, but we look to take advantage of that in those buy low opportunities. It's also when the markets recover and recover above expectations, we might be taking profits. What I think is interesting is we're looking at 22 years worth of data here. There's only been 6 years where the public markets have produced an excess return over private markets, which is extremely compelling. However, looking at last year, 2022, you had public markets, S&P down 18, you had Nasdaq down 32%, and you had on average privately held markets or private markets up over 5%, creating an excess return for private markets relative to public of over 36%. So if you're listening to this or you're an investor that has no exposure to private markets or maybe low exposure to private markets, is it too late? Do you look at last year's excess return and potentially pause your allocation? What are your thoughts there, Pat?
I don't think that. Well, what this is showing is, and this is a interesting moment in time because you would think a balanced portfolio that a lot of folks rely on, and when we talk about diversification, think that credit will public credit or treasuries or wherever the Barclays Ag, which is the benchmark for
Sure.
credit, will balance out your stocks. And there's a lot of different types of way to talk about those correlations, but one simple way that where what happened last year was that both of those went down in the same year when that historically does not happen over time. So when that does happen, particularly so in this one particularly is talking about equities, private equity outperformed simply because so many people panicked and sold equity, their public equities. So at this moment in time throughout that calendar year, you just, as I mentioned before, you just don't have those drawdowns. And so I think I truly think that over even in this period of time, and we can dive into the details, but um, private equity managers are going to always have an interesting opportunity set. We'll talk a little bit about secondaries, but there's ways to take advantage of continuing to invest in the private market because you want exposure to more companies. Like I think the NASDAQ, 40% of the NASDAQ is made up of 5 names that
Hmm.
control the majority of the market cap of the NASDAQ. You certainly, maybe you want to invest in that because the NASDAQ has been down a lot so far, and it's done really well this year. But still, I think you want that exposure to more companies, and one way to do that is through secondaries, and I think that would be an interesting place to start.
Yeah, so that's an area of opportunity in your opinion is the secondaries. Maybe back up. What is the secondary market? Maybe
Yeah,
describe that. Almost like we led off with what are private markets.
yeah,
What's the secondary market as it relates to private companies and private equity?
yeah. So a secondary market is essentially um, it's when somebody that's invested in a private equity fund, an investor in that fund, um, is ready to exit that hold and sell it on the on a secondary exchange. It's not really an exchange, but it's a group of private managers that get together and want to transact. And so
Is
when
it
they do
almost like an
that,
auction?
it's like an auction.
Yeah.
It is very much like an auction. So I may own a private equity fund that owns 10 great companies inside of it, but my investment policy statement, says that if I have too much private equity, I should rebalance my portfolio. And so folks go through the secondary market, an auction process to sell it.
And I
Well,
know we've talked about this, Pat. We've been looking at that's happening. You're having the major owners of private investments and private markets are still pension funds, endowments, and large institutions, and they're managed by an investment committee. That investment committee is many times held to an asset allocation, and with
mhm,
stocks down over 20% on average last year, you had bonds down over 10%, but private markets positive a couple percent. That portfolio has been thrown out of out of the target allocation, so we are having forced sellers into this auction process or this secondary market.
yeah.
Explain how you could take advantage of that.
Well, simply, one advantage is to buy things at the cheaper you buy it, the sort of the better opportunity you have. You want to buy low and sell high, right?
Right,
So
right.
we look on the right side of the chart here. Currently, venture capital is selling at a steeper discount. Venture, I always think about venture as like your small caps or your growth stocks in your if you're a growth if you're a public market investor, I like a growth stuff, and then I have mega cap or value or things like that. And buyout is sort of considered more of like your larger private companies that may not be in as much growth mode.
Mm.
And so there's a huge way to buy. There's a lot of opportunities to buy secondary stuff in venture at steep discounts, and same on buyout. Normally, these are trading at around 100% or par or right around there. Right now, there's a major window of discount, and so you want to take advantage of these windows when they're around.
Yeah.
These
So what
private
we're doing
companies don't come up for sale very often.
exactly, and I know that's an idea that you've shared with us, and we're currently looking at funds that are heavily investing and buying in the secondary market, trying to take advantage of that inefficiency that's currently present, where we have discounts and buy low opportunities. So this is
Yeah.
extremely compelling to see that drop off. And once again, you know, investments sometimes return to the means. You typically want to be a buyer when things are cheap, although that also comes with having a little bit of conviction and a stomach to swallow some of these large fluctuations. Um, so as we kind of just briefly hit on real estate, which
Yep.
is a fairly hot topic as of late, that has
Mhm.
been heavily affected by interest rates. We have one slide that I think is
Yeah.
going to hopefully provide a decent perspective on real estate and positioning and opportunities. Talk us through this slide, Pat.
Yeah, there's not a whole lot to talk about with real estate specifically, but one thing I do want to talk about is sort of over a long periods of time, real estate has outperformed, particularly in inflationary environments. And I think everybody knows the value of real estate because they're not making any more of it, so they say. And I think there have been headlines in certain major metropolitan areas that where offices and people aren't going back to work, and that's true. And I think when we invest and when we talk to folks like you, Rory, and we look at what's appropriate for clients, they're looking at things more like the higher bar charts. And of course, these are projections going forward. And as of March 22, you've got these 5-year historical returns, and then the diamonds is sort of where the projections are going to be. And obviously, we want to be in industrial and multifamily and student housing and life sciences and underweight because there's about a 2% difference over the next 5 years. So compounded over time, these are double-digit differences. And so everything that we're offering our clients currently, we have a conviction mainly around things like multifamily and industrial, life sciences, and underweight office, and malls, which
Yeah.
can be a surprise. But the bottom line is the headlines would say one thing, but if we like real estate, we can express that through credit or equity. But certainly, you have to think sector.
Yeah. Yeah. I know real estate has been an area that we allocated towards a number of years ago, and the returns have exceeded expectations. So yeah, there might be a little bit of headwinds associated with higher interest rates,
Yep.
but we're still generally the typical private real estate investment is yielding close to 5%. Maybe there's a little bit of a lull, but ultimately still providing some extremely beneficial diversification to the portfolio. Um, so great, Pat. We're about ready to wrap up here,
Yep.
but we wanted to save time for
Yeah. This is an
private
easy one.
credit and
Yeah.
private loans. You say easy, but I mean the title doesn't sound easy. Sponsored versus non-sponsored
The
leveraged
title,
loans. What does
the
that mean?
title is intimidating, but
That's right.
ignore. Sponsored means is it the company owned by a private equity firm that borrowed the money, or is it owned by like your mom and pop CEO, private owner? But what I want to focus here is on the left chart because I think this one's easier to explain. The bar chart on the left, you have the gray bar and a blue bar, and this is the gray bars are the public loans that are out there. So when you buy a high yield bond fund or a high yield bank loan fund, those loans that are in that fund are what's inside of the gray bar.
Okay.
They're made by banks. They're syndicated by a group syndicated bank. And if they're not, if it's a loan made to a private company or a private loan that was made, it's the purple bar.
Hmm.
And what have you seen since the beginning of 2021? The banks have completely disappeared.
Yes. I mean, that's abundantly clear. I mean, that's one at the far right corner for the gray bar there.
Yeah. And I mean, when you look at what happened with the banks at the beginning of the year, They've stopped lending.
Yeah.
So even if you needed like a $600 million loan, which seems like a ton of money, which it is, you're going to have a hard time going to a bank. You would think, oh yeah, like a bank is going to be able to help you here. Really, they're trying to make mega loans to mega companies to keep the credit, as the lifeblood of the economy. But um, if you go, what we're talking about, private credit, if you understand public credit,
Hmm.
you're missing the diversification benefits. Again, if you're buying only public high yield bonds and high yield bank loans or investment grade or whatever you want to call it, um, there's a major decline in supply
Yeah.
and fewer diversification benefits. You're investing more. People are lending money to the same companies that maybe aren't doing as well, but they have to put the money into the markets. Well,
Hmm.
you may just say, well, wait a minute, I don't have to loan to these companies just because they're public. I can loan to make a private loan through a lender that can help guide them on and
Hmm.
say, how do we want to do this? And
Well,
I
before
hope
we get to
belabor the point.
yeah,
Yeah.
before we get to performance and are private loans and private credit as an investment superior to a public loan or
Yeah.
buying public bonds, how do you get access to private loans? Just high level.
Um,
Or what are some private loan, investments? Are we talking
okay.
mutual funds? Are we talking like
Well,
capital
yeah,
call structures? Because I think that that's an area
yeah,
that, people might understand. Okay, if the banks are not lending, private loans are the only essentially access point. If you're an individual investor,
yeah.
you know, can you get that on your own or invest in a private loan? Like,
Right.
how would you take advantage of what's very, very clearly happening?
Yeah. So the short answer is, let's say back in the 50s and 60s, people bought stocks and bonds directly. Like
Yeah.
you get you get a certificate of a stock certificate. Then it moved to mutual funds, and they had mutual funds back then, but they really got bigger in the next were the advent of mutual funds. Then it was the advent of ETFs. And just to put into layman's terms, there are new structures that are not particularly new, but more popular structures now that only make private loans to private companies. One's called the business development company,
Okay.
which is actually like the private version of a REIT. So we all know REITs.
Yeah.
It's called a BD. The business development company stands for BDC. Um, and so that's one structure that by law has an advantage where it can make it can make loans to U.S. companies. And it gives them the ability to do that. And you have access to that, Rory, and through our platform if you're a financial professional. There's also a structure called an interval fund that looks and feels like a lot like a mutual fund, but it has limited liquidity. And the reason it has limited liquidity is because you can't turn on your bond desk and buy them. You have to you have to find a company to lend to.
Sure.
You have to have a CFO call you and say, hey, I want to make a loan
Yeah.
and negotiate that. So
Okay. No, that's
those are
helpful. I
very
think that was
friendly.
worth. Yeah, that just was worth pointing out. And
Yeah.
interval funds are, fairly new to us. We didn't leverage them or really have access to them when we were at Merrill Lynch. But it's something that we've been doing our due diligence on, and in fact, that's what we're using to get exposure to this asset class. And speaking of the asset class, at the end of the day, we care about the performance. So yes, there's an opportunity, but does that come to fruition in terms of actual returns for our clients? And this chart is pretty spectacular in terms of looking at top to bottom here, private credit, treasury bonds, investment grade bonds, cash, leverage loans or bank loans like you just spoke to, or high yield bonds, which are low quality bonds, sometimes referred to as junk. So we're going back to 2007 here and looking at the calendar year performance. And it's abundantly clear the green, which is private credit, has produced significantly superior returns. To sum all of that up, maybe speak to the returns and the volatility that you're seeing from an aggregate standpoint at the
Mhm.
bottom of this chart here.
Yeah, well, so clearly, I'll call out that private credit does the highest return and has lowest volatility, aside from cash. But I would say that one thing I would notice is that private credit's never in the bottom half.
Yeah,
So
it's never bottom two. In
it's never
fact,
in the
over the
bottom exactly. So
yeah,
you're, even like in an '08 scenario, Yeah, it was down 6, but if you're in high yield, you're down 26. That's like a ballast of your my bonds were down, leveraged loans are down 30.
Yeah.
So you're getting all the benefits. And I think it's again, look at the following year, high yield was up 58, but and it could outperform at times,
That's
but
a
I'd
roller coaster.
rather the
Yeah.
role of my portfolio for
Yeah.
credit is not to be up 58%. It's to be clipping a solid coupon. The yields in private credit also generally are 3 to 5% above the high
Yeah.
yield bonds. So, or the
So
loans.
this is an interesting question for you. I'm just curious of your opinion. There's no real right or wrong answer. It's kind of perspective. But
Yeah.
this chart is comparing private credit or private loans to bonds. Do you think that private credit should be looked at as part of your bond allocation, or do you think it is a completely separate sleeve inside of a portfolio?
I think it's definitely from the bond portfolio. I
Okay.
think it replaced. What's interesting is while it has equity-like returns, I mean, equities over time have returned 9%, or
Yeah.
not 8 to 10, wherever you want to pick your time series, but with half the volatility, if not more. So it looks like an equity, but in reality, the the reason it should be a replacement for your high yield or leveraged loans is because um, it's like floating rate. They have its first lien in the capital structure is a contract where you are making a loan to a company. Going back to
Mhm.
the very beginning of this conversation, you're making a loan to a company. It should
Yeah.
be part of that bucket because of the return, the excess return you're not going to get in equities. So I think that's why I put it in that bucket, but
Okay.
it's certainly an amazing place to be.
No, I was just curious. What's, obviously the returns are superior, but what's even more surprising is the volatility is extremely low. With interest rates having increased, bonds struggled last year to the tune of them being down 13%. But the typical bond portfolio, I think the Lehman Ag right now is yielding between 4 and 5%. The interval fund that we're using to get clients exposure to private credit is yielding over 10%. So it's kind of double the interest that you're going to receive in the private credit interval fund relative to buying the Lehman aggregate. And dating back to 2007, that's also coming with less volatility. And it's why it's one of our highest conviction ideas for 2023 and beyond, because with interest rates rising, these private credit are not fixed rate loans. Some of them are
Hmm.
variable. So I actually think, and per some of our discussions with you, that private credit, despite the excess performance over the last few years, is positioned to continue to perform above where you would get treasury bonds or investment grade bonds, because the yield difference is now significantly more than it was before. So,
Yeah,
um, Pat,
absolutely.
this has been great. I appreciate your time as always to dive a little bit deeper into the private markets. We highlighted private equity, that there are a lot more privately held businesses than there are public businesses. We've also seen excess performance from investing in private equity than investing in a stock portfolio that is U.S. and international. We talked about, yes, real estate, might be slowing a little bit here, but you want to be selective. And then also private credit, where there's, I think, a tremendous opportunity to maybe enhance the safe side of your portfolio, the bond side of the portfolio. So with that, I appreciate your time. I know you're very busy with your research and heading the alternative investments department. It really means a lot to join us here and help the April monthly webinar.
Oh, well, thanks for having me, Rory. This is a great discussion. I love having these. So anytime, if you have questions, go through you. Be happy to continue the discussion. Appreciate it.
Great. Thanks a lot, Pat. Have a great rest of your week. Everyone who tuned in, thank you for joining. Again, we're going to be ending this recording, but you'll find a number of these snippets on YouTube. So make sure to check out that channel and have a great rest of the week. Thank you.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.